Coca-Cola is one of the most popular dividend growth stocks in the current stock market. They have been raising their dividends consecutively over the past 6 years, which grants them the title of the Dividend King. Now, since 1984, the company is up by more than 5,500%, and over the past 5 years, the company has been on a fairly bumpy ride, and it's currently sitting at about $61 per share, which is more than 40% higher than what it was sitting 5 years ago. Now, when we jump to the monthly full, we can see that the analysts currently expect Coca-Cola's top line growth to be more than 4% this year before accelerating to more than 5% growth next year, where this revenue growth should pump up the 2020's bottom line of $2.48 per share to $2.61 per share, which should root to $2.81 per share in 2024. And when we jump to tip ranks, we can see that the analysts currently have a 15% upside for Coca-Cola, predicting a price of $70.25 by the end of 2023, with the lowest price target of $63, which is still higher than the current trading price of the company. Now, to value Coca-Cola in a bit more depth, we'll jump over to our fully automatic stock valuation spreadsheets, where we will have a look at the 9-pillar analysis and calculate the intrinsic value of the company using 4 different valuation models. Now, when we jump back to the stock screener and direct our attention to the dividends tab, we can see that the current dividend yield of Coca-Cola is sitting at about 3%, with a dividend payout of $1.84 per share per year. Now, the trailing payout ratio for Coca-Cola is sitting slightly higher than I generally like to see, sitting at 83.5%. But as Coca-Cola does not need to direct a large proportion of their income towards innovation, a higher payout ratio is not that big of a deal. Now, looking at the beta of the company, which is sitting at 0.55, which means that you really won't see as much volatility with Coca-Cola as you would with the overall market. Now, before jumping to the intrinsic valuation models, we'll jump over to the 9-pillar analysis, and I created this sheet to view the historical data of a company to help me decide whether a stock is a good purchase and whether it has the potential to grow my investments over the long term. Now, the first pillar we want to look at is the 5-year PE ratio, and we want this to be sitting below 22.5, which would mean that the company is fairly valued compared to their earnings. Coca-Cola's 5-year PE ratio is sitting at about 28, which means that you might be overpaying for what they are earning. Now, for the next metric, we want the 5-year profit margin to be above 10%. As we can see, Coca-Cola is sitting at about 60% profit margin, so that is in the green. Next, we want there to be net income, revenue, and free cash flow growth over the past 5 years. And as we can see, Coca-Cola has been increasing all 3. Now, for the next metric, we want there to be a decrease in shares outstanding. And if we scroll down to the financials, we can see that Coca-Cola has actually decreased their shares slightly over the past 8 years. But as an investor into Coca-Cola, I would like them to decrease their shares outstanding a bit more so that I would own a larger portion of the company. Now, for the next metric, and probably my favorite metric, the long-term liabilities over the 5-year free cash flow negative dividends to be sitting below 3. And what this basically tells me is that a company has enough free cash flow to pay off for all their long-term liabilities while paying out their current dividend. As we can see, Coca-Cola is currently sitting at about 4.65, which means that they would take about 23 years to pay off all their long-term liabilities while paying out their current dividend. Now, for the 9th and final metric, we want there to be consecutive dividend growth over the past few years. And as Coca-Cola is a dividend king, they have been increasing their dividend by about 4.5% annually. Now we can move to calculating the intrinsic value of the company, and first we're going to use the Grams formula revised. Here we're going to take the earnings per share of Coca-Cola, the base PE, the 5-year growth estimate sitting at about 11, the growth rate multiplier sitting at 1, the average yield on AA Corporation bonds, and the current yield on AA Corporation bonds. And this will give us an intrinsic value of $38.12, which is about 60% lower than the current trading price of Coca-Cola. Now, the reason for this high difference might be the current yield on AA Corporation bonds. Now, if we plug in the short-term average, which is about 3.5, we would get an intrinsic value of $50.43, which is only 21% lower than the current trading price of the company. Now moving to the next model, the discounted cash flow model, we take the free cash flow over the past few years and calculate the average growth rate to be sitting at 4.02%. Now I calculate a growth rate of 4% over the next few years, and using that I calculate the future free cash flow up till the year 2031. I then take the discount rate of the company sitting at 6% and calculate the present value of that future free cash flow. I add that all up, add any cash and cash equivalents, subtract total debt, and get an equity value, which I divide by the shares outstanding and get an intrinsic value of $65.36 per share, which is about $4 higher than the current trading price of Coca-Cola. Now when finding the intrinsic value of a company, we also want to compare the companies to companies which operate in the same sector. And to do this, we have the multiples valuation model. Here we compare Coca-Cola to Pepsi and Monster Beverage. I take these companies' current stock prices and divide by their earnings per share to get their price to earnings ratios. I then average these out and multiply by the earnings per share of Coca-Cola to get an intrinsic value of $88.48. Now looking at the average PE ratio of these two companies and comparing it to the PE ratio of Coca-Cola, we can see that the price to earnings of Coca-Cola is indeed lower than the price to earnings of these two companies, and therefore the higher intrinsic value. Now moving to the last valuation model, the dividend discount model, we take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 3.32%. For the future, I project a growth of 3% per year as Coca-Cola's long-term liabilities are sitting quite high and their dividend payout ratio is sitting quite high as well. I then take the WACC of the company and the next year's dividend projected through our projected growth rate and arrive at an intrinsic value of $73.87. Again, quite higher than the current trading price of the company. Now to calculate the ultimate intrinsic value of Coca-Cola, we will average out the 4 valuation models and arrive at an ultimate intrinsic value of $69.54, which is 13.83% higher than the current trading price of the company. Now if we plug in a margin of safety of 25%, we would get an acceptable buy price at $52.15. Now if I plug in a margin of safety of 15%, the margin of safety I like to go with, we would get an acceptable buy price at $59.11. If you find these spreadsheets interesting and helpful, you can download them at my Patreon at the link in the description. With that, if you enjoyed the video, make sure to leave a like and consider subscribing.